India's exports of goods shrank 12.7% on year to $34.66 billion in the first month of financial year 24. We're talking about month of April. Sluggish demand and recession in major markets and the Russian-Ukrainian conflict made an active impact. What's interesting, however, is that trade deficit also fell to a 20-month low of $15.2 billion in April against $18.36 billion a year ago. Now, this on the back of cooling commodity prices, especially of petroleum, which led to a sharp 14% contraction in imports. So both imports and exports contracting there. Now, India's top export items in April of 2023 include engineering goods, petroleum products, gems and jewelry, drugs, pharma and chemicals. Its top imports are petroleum, electronic goods, machinery, coal and chemicals. Now, although the demand scenario for Europe and the US was not very optimistic in the short run, officials are expecting an increased demand over the next few years. On the show, what is driving the dichotomy of both contracting exports and imports and as a resultant trade deficit in India? Joining me at this point in time, Vivek Kumar, who's an economist with QuantEco Research. Also with me is Kartik. Kartik, what explains the dichotomy?
Not a dichotomy really as I see it. See, what are net exports or, the deficit or the surplus? Export minus import, right? So a contracting deficit in this case is on account of both exports and imports reducing and reducing in absolute terms, exports reducing a little more than imports reducing, or maybe I got that reverse, eventually resulting in the net contraction. Okay. So no dichotomy really, I think simple math, export minus import.
Okay, but it's interesting because if you try and understand how exports and imports are playing up, what's important to figure out is that while exports are reducing on the back of sluggish demand, the trade deficit is narrowing because petroleum prices have cooled down, commodity prices have cooled down. And Vivek, I want to get you in here. How do you read these trends for common man?
Well, from a common man perspective, I think what matters is obviously crude oil. And to some extent, I think the essential items which would get covered either in the pharma basket or maybe the agri basket. Now, from a prices perspective, we've seen that that moderation in global commodity prices after the peak in June, July of last year. Since then, the entire commodity basket, maybe barring the precious metals basket as such, has definitely cooled down. And this has happened in the backdrop of persistence of geopolitical tensions across the world. So despite that, we've seen commodity prices cooling off, and this tells you that there is a concern with respect to global demand, which is getting manifested. From a end user perspective, I think the end user is definitely in a better shape than what he or she was in the middle of 2022, because in the middle of 2022, just to take a step back, we were facing extremely high prices on semiconductors. We were facing extremely high prices on edible oils, especially vegetable oils. We are facing extremely high prices on fertilizers. All these have come up significantly. Now, it's another matter that for Indian consumers, the crude oil price or the benefit of crude oil price decline has not been passed on. But from a producer perspective, there has been a passage of the international crude oil prices to lower prices as far as the producer class is concerned. So to some extent, I guess the pass-through is partial for the Indian consumer as such. But if we were to take a yearly view compared to how things were a year ago, the end consumer in India should be in a somewhat better shape than what he or she is now.
Okay. So from what I understand, so while recession, Russia-Ukraine is playing a dampener, cooling of commodity prices has worked in favor of India, Kartik.
That's right. And in fact, in addition to that, when you talk about commodities, Shweta, I want to also talk about gold. And gold has actually seen record prices this year. And it's never reached the levels that gold has actually touched this year. And gold has become an expensive commodity. Incidentally, despite being a large gold consumer market, probably because of inflation, probably because of reduced incomes, because of the overall economic scenario in the world, and also in some parts of India and some sectors specifically in India, gold imports have actually contracted, and they've contracted significantly. About 41.48% is the contraction in gold. On the flip side, while exports have also overall shrunk, one sector that I was very positively impressed with was the electronics. Electronics exports have actually grown about 26%. So overall, I think this balance is playing out well, that PLI schemes, the overall setting up of Apple factories, etc. in India, Samsung manufacturing in India, all this has led to some sort of a resurgence in export of electronic items. And despite gold being at a record high, we haven't seen record consumption in gold.
Okay. What's your expectation, Vivek? Because a lot of these factors, for example, recession, how do you see it panning out over the course of next, let's say, a quarter or a quarter more to come in? And if that continues, we'll see exports further shrinking. What sort of impact will that have on Indian exports and trade deficit?
Now, as far as the talk of recession is concerned, I guess this is one of the most widely expected recession which has still not played out. So we've been expecting a recession for the past 2 quarters, and the recession still seems to be somewhat elusive. Having said that, there is a very strong expectation that even if there is a recession or maybe just about a hard landing scenario, which kind of plays out given the record amount of monetary tightening which has happened across the world, the forecasts by the international agencies suggest that the global GDP growth could be somewhat about 50-60 basis points lower. So from an estimated level of 3.4% in 2022, most of the multilateral agencies have downgraded their GDP projection for 2023 by about 50-60 basis points. So in some sense, it kind of takes that into account. And whether the recession actually plays out, does not play out, I think that's probably going to be immaterial. What's probably would be much of much more significance is the extent of slowdown that we are likely to see. And our export numbers, to that extent, have already started manifesting that. Now, if you see, our exports on a year-on-year basis have been contracting for the last 3 consecutive months. So February, March, April, our year-on-year numbers on exports have been in negative territory. And this is just the start. So as you move forward, as the tight financial conditions and the credit market uncertainty in the US takes more of a toll, you'll see growth slow down getting much more pronounced. And the expectation that going forward, exports for the year could be anywhere down between 5 to 10%. I think that is a fair estimate to make. Now, to a large extent, I would say the prices also play a role here, because if, let's say, we are comparing exports, we typically tend to compare exports or imports for that matter in dollar terms. And prices do play a very important role. So, for example, for last financial year, your price for Brent, the crude oil benchmark for Europe, was close to $95-96 per barrel. As of now, the crude oil prices are currently hovering around $75. So there is a clear discount of at least $20 vis-a-vis what we saw last year on an average basis. Now, if the trend persists, you'll see that impact in your export as well as your import numbers in a very strong manner. So all depends to a large extent as to where do commodity prices settle down finally. If you look at the broader benchmark of commodities, whether it is the Bloomberg Commodity Index or the Reuters CRB Commodity Index, most of these indices are down by anywhere between 10 to 15% as we speak now. So that impact will be there. There will also be some sort of a slowing down impact on the volumes, which will come from slowdown in GDP growth, and thereafter your demand will take some bit of a hit. But demand, nevertheless, is not expected to be negative. It is still expected to be positive, given the underlying strength in GDP growth. So GDP is not expected to turn into a negative territory in 2023. The pronounced impact is going to come from the commodity prices, as far as we believe.
Vivek, if I can just step in here, talk me through the export scenario in the services sector. And that has in fact seen a jump from $24 billion to about $30 billion or so. And this despite inflation in the US, despite banking crisis in the US, despite big tech slashing down on jobs and costs overall. So why this jump in services exports? Is it on account of a weaker rupee as against the US dollar, or is it movement of employee-related work in big tech and banking moving into back offices in India?
So it's a very good question because it's something which we feel is the underlying strength for India's trade data, at least in the last few quarters. And if I can take the liberty of dividing the overall export basket into three, on the services side, into three main categories. One is your travel related services. One is your software related services, which India has been one of the leaders in the global arena. And the third is the business related services. So these are more in the area of consulting services, which has started to come up in a very big way in the last 3 or 4 quarters. Now, travel, we all know, was largely suppressed post-COVID. It's been only last 2 or 3 quarters that travel slowly has got opened up globally. And we are seeing that impact in our numbers, in our services numbers. So travel is a turnaround story which has been contingent upon the reopening of economies post-COVID. So that was something which was on along the expected line. The IT or the services or the software services component has been pretty strong uh, right through the COVID time, and this is despite the expectation of slowdown in the developed market. One expectation here is that post-COVID, the thrust on digitalization that companies have had, the thrust on cost cutting that companies have had, has been impacting countries which are exporting such kind of services in a positive manner. So India has actually been, uh, I would say, from the COVID perspective, the shock on services was positive. The third or the emerging category in services is the business services category. Now, within this services category, there are a whole host of services, right from legal services, accounting services, data management services. And some of these services have come up in a big way in the last few years. So, for example, take for example, setting up of data services or data or analytical service centers in India. A large part of these services, whether they are being run by software dominated companies or whether they are run by artificial intelligence based companies, I think it's that does not matter. What matters is that a large part of global analytical and consulting services is now getting exported out of India, and this is one category which has been growing at a superlative growth compared to the overall services basket.
Right. And I think no discussion on imports and exports can ever be complete without really bringing the C word, the China word into it. So, with China opening up and China open for business again, do you think that's going to be a dent for India's overall export basket on the goods side? And parallelly, are we going to start importing more from China as well? So, overall, is the deficit instead of narrowing going to widen with China opening up?
So, frankly speaking, this was a concern at the beginning of the year. That was the time when China had opened up their economy. And the experience in trade with respect to trade data for the last 4 months does not suggest that those concerns have necessarily played out. In fact, I would say I would probably see it from a positive perspective because India, despite the uh, the gyrations in the global trade scenario in the last few quarters, despite the volatility in commodity prices seen in the last 3 or 4 quarters, India has managed to increase its global share in both merchandise, which is goods, as well as on the services front. Their export market share has gone up. And in the entire COVID period, India's export market share has risen by 0.3 percentage points. So that to me is a telling statistic because our export market share was kind of almost static for nearly about a decade.
That's right.
And we managed to increase our share during the phase of the pandemic. And this has happened despite some of the constraints on availability of natural resources, availability of labor, and different sorts of countries imposing their own restrictions as far as COVID or maybe geopolitics is concerned. So that to
Right.
me is a telling tale. Some of the factors have played a turnaround story. PLI is one of them, as
Right.
you rightfully mentioned. Although PLI has had a localized success with respect to electronics, the expectation is that going forward, this success in electronics can possibly get replicated in some of the other sectors which it is targeting. Services has been a very pleasant surprise to all of us who've been
Yeah.
tracking Indian economy very closely. And it's not just IT; it's the business services component which has posed a very pleasant and a very big surprise to us.
Right. So, if you'll permit me, Shweta, one more question, Vivek, before I hand it back to Shweta. Now, there is optimism in Ministry of Commerce suggesting that by August, September, we will see that the discretionary spending internationally in US and in Europe is going to come back, and that is going to give a fillip to India's exports. Do you see the situation internationally settling down in the August-September time frame? And would US specifically have come out of this high inflation and high interest rate cycle that it finds itself in the middle of right now?
And just to add to that, and the fears of a prolonged Russia-Ukraine conflict, do you think that results have played out now? Because the war has been on for a year now, or do you think there's going to be further impact on supply side and that could affect India's exports and imports?
Okay, so both these questions, I'll take the second one first. Uh, the second one first because Russia-Ukraine war has been on for more than a year now. And I think the global value chains across the world have to some extent got used to the conditions. So one of the international benchmarks used for assessing the impact on global value chains is the New York Federal Reserve's Global Supply Chain Index. And that supply chain index, which is available on a monthly basis, tells us that the current level of disruption in the global supply chain is equivalent to what was maybe 10 years ago. So we've kind of nullified, we've kind of ironed out the entire COVID era disruption on global supply chain as we speak today. So most of, while we can still have very localized disturbances in certain commodities, overall, from a global trade perspective, the supply chain disruptions have largely got ironed out. So that is one, which is with respect to the global supply chain and the impact from the Russia-Ukraine war. The second aspect of Russia-Ukraine war is that India, interestingly, has turned out to be a beneficiary of what is happening because India has been procuring crude oil from Russia at a discounted rate. That discount is anywhere close to 25 to $30 to a barrel vis-a-vis the European benchmark for Brent. And what this is doing is that it is reducing our import bill, especially the oil import bill.
Right.
To some extent, we have now also started seeing Russia's increasing share in terms of the import that we do in case of vegetable oil, as well as the imports that we do on account of fertilizers. Although we don't have any price arbitrage that we enjoy as we do in case of oil, but nevertheless, we are seeing increasing penetration of Russia in our import basket. The number that Russia had before the crisis was anywhere between 2 to 2.5% in our import basket. As we stand today, the number is somewhere close to 9.5%. So that's a significant amount of jump in the last 1 year. And we've actually enjoyed a little bit of price arbitrage that is helping our trade deficit to stay somewhat lower than ideally it would have had the Russia-Ukraine war not happened. So that's the unintended but a positive impact of the Russia-Ukraine war from a trade deficit perspective for India. The first question that we had on the
US
discretionary
inflation.
spending, yes, the discretionary spending by developed countries, especially in case of US and maybe Europe. Now, there are two things again here. One is the uncertainty that these economies, these major economies have been subjected to in the last 1 year from the interest rate perspective. That is to a large extent behind us. After the rate hike in May, the Federal Reserve has more or less hinted that they are now done with the interest rate tightening. Now,
Right.
that does not mean that good days are ahead. What it does mean is that the uncertainty or the markets trying to guess where the terminal rate for the federal fund for the federal funds rate is going to lie, that is now going to be behind us. So we are no longer in that guessing game. Every meeting is the Fed going to hike by 25, 50, 75 basis points. So that uncertainty is out of the way. What still needs to be contended with is the fact that the Federal Reserve over the course of last 13, 14 months has delivered a hike of 500 basis points.
That's right.
Ideally, in the prior interest rate cycles, such a magnitude of interest rate hike would have played out over the course of 2 to 3 years. This time around, it has played out in just about 13, 14 months.
That's
We are
right.
seeing the unintended consequences of this record amount of monetary tightening in the form of bank
Banks going
failures in
down.
the US.
Right.
Yes, thankfully, the problem so far is localized. It's largely pertaining to the regional banks in the US. But you just have to look at how the regional stock index in the US is performing. The regional bank stock index would be down by anywhere between 50 to 55% on a YTD basis, whereas the benchmark S&P would be up by 2 to 3% on a YTD basis. That's the kind of divide that you have for the broader economy on one hand and regional banks on the other hand.
Right.
Okay.
Now, regional banks ultimately do provide credit to the end consumer, whether they are producers or the private consumers. That's immaterial. But some sort of a credit tightening is bound to happen, and it's already started. Your credit growth, deposit growth for the system as a whole in the US has started to turn negative. So the sense here is that
So
the
September,
credit
does it look likely? A short answer, is September too optimistic timeline?
It's too optimistic a timeline because too optimistic a timeline because typically interest rate tightening or interest rate actions impact with some lag,
That's
and
right.
that lag is anywhere between 2 to 4 quarters. So if let's say the Fed has stopped in May, you could expect the lag to end somewhere around March quarter of next financial year.
That's right.
So that lag will continue to permeate. So September would be too early to expect things to turn around.
Okay.